Good afternoon, everybody. My name is Andrew Schaefer from Trafalgar. I'm joining you from our Johannesburg branch near Melrose. I'd like to start by welcoming my colleagues who will be presenting this evening. As usual, we've got Karine Kutsia, my colleague based in Cape Town. Karine is our National Property Manager Consultant with 20 plus years experience. And Karine will kick us off tonight just talking through the legislative provisions around both insurance as well as finance and loans. So Karine will kick us off. Thereafter, Christian Joubert, my colleague based in Stellenbosch. Christian is our finance specialist, so he will talk about levy finance options, about loans, and about financing requirements which arise from time to time in community schemes. And then we'll end off after that with Levy Pinto, who's Trafalgar's national brokerage manager in Trafalgar Financial Services. Levy is a community scheme insurance specialist, closely involved with insurance cover claims and well placed to discuss what to think about with insurance and some tips and good practices as well. So thank you very much for joining us. We aim to conclude promptly at 6 o'clock. So we'll follow the agenda. I will try and answer questions. If you could please just pose them in the Q&A. We'll try and type answers. If you would like copies of the slideshow of the recording as well as the Q&A, please just privately submit your email address. We'll pick up your email address from the Q&A afterwards, and we'll gladly send you copies of the materials when they're available and when they're uploaded, and we'll do that with pleasure. All right, so thank you very much, Karine. I'm going to hand over to you, and we'll kick off with legislative requirements relative to the topics of loans as well as insurance. Thank you.
Thank you, Andrew. So yeah, as always, I look at the Act first. So I look at the Sectional Title Schemes Management Act and the topic of insurance and what does the Act say. So the very first thing I see in Section 3 is that the Act prescribes the body corporate must insure the buildings and the common property. So that is a requirement by the Act. It is not an optional extra. It is something that must be done. If you look at Regulation 3 of the Sectional Title Schemes Management Act, it also stipulates what must be included in this insurance cover, things like lightning, explosion and smoke, riots and strikes, earthquakes, which we recently had in Joburg, impact by vehicles and other things. And then we look at Prescribed Management Rule 23 of the Act that also deals with insurance. And it stipulates that the body corporate can pass a special resolution to determine further instances that the insurance must cover. So it is possible for a body corporate to cover extra things under the insurance. They just need to pass a special resolution. If you are not sure what a special resolution is, you're welcome to contact me. We have an easy guide to resolutions that explains all the different resolutions and how to obtain them. The Act also says that the insurance policy must include a replacement value for each unit. So that's some things in terms of Prescribed Management Rule 23. If we continue with Prescribed Management Rule 23, you'll see that it says that an owner is responsible for the excess in a claim for any part of the buildings that he or she is obliged to repair or maintain. So if it is there, you have an insurance claim with regards to your section, the owner is responsible for maintenance of the section, so then the owner will be responsible for that excess. If the claim is for for the common property, then the body corporate is responsible for maintenance of the body corporate, so the body corporate will be responsible for the excess. There's also a new stipulation, or not that new anymore, but since 7 October 2016, it is a requirement of each and every body corporate to have a valuation done every 3 years, and this must then be presented to the AGM. That is also in Prescribed Management Rule 23. And then in terms of the CSOS Act, there's another stipulation in Regulation 15 that says that each body corporate must take out fidelity insurance against the risk of loss of money. Now, Levy is more the expert on this, but Trafalgar, as part of the service to our clients, have fidelity cover in place that ensures our schemes against the risk of loss of money. If we look at a homeowners association, remember everything that I just said is pertaining sectional title schemes, but I know we have got some homeowners associations out there as well. There is no such thing as an act like the Sectional Title Schemes Management Act that governs insurance and things like that. HOAs are not governed by the Sectional Title Schemes Management Act. They are governed by their MOI, their Memorandum of Incorporation, or their constitution if it's a common law association. So if there's any queries with regards to insurance on an HOA, those are the documents that we will have to look at to see what it says with regarding to that. Then the topic that Christian is going to cover, to look at what the Act says about that in terms of loans. If the body corporate wants to take out a loan for a specific project for whatever reason, you must obtain a special resolution. And as I said before, you're not sure what a special resolution is or how to obtain it, please email me. I can send you our easy guide to resolutions that explains all of that very nicely. So yeah, that's it from my side. Thanks, Andrew.
Karine, just a practical question which has actually come up today. Do you want to just talk to what is presented at the AGM in terms of the insurance replacement schedule, and that the bond holders can typically ask for an increased insurance value on the sections that they are providing bond finance for, and that extra premium then would be debited to the particular unit owner? Just a few comments on that, please.
Yeah, Andrew, exactly that. So sometimes bondholders ask the managing agent for an insurance certificate, which we obtain through our brokers. The managing agent can't issue that. The brokers have to issue that. And then sometimes the bondholders come back and say, but we feel that this unit that we have a bond over has to actually be insured for a bit more. And then they increase the replacement value for that specific section. And then the owner will become responsible. It's normally a small increase in the premium for that unit. It will just be for a year that the owner will then have to pay. And then after that year, it will be absorbed into the levies again. So that does sometimes happen, that the bondholders request an increase, yes.
Okay, perfect. All right, many thanks, Karine. So Christian, if we can move on to your topic, please.
Sure. Just testing, Karine, can you hear me perfectly fine?
Yes.
Awesome. Afternoon all, I'm Christian Joubert. I head up our finance products, specifically dealing with vanilla loans and levy finance. For those that are not aware, our financial services company, TFS, is the authorized financial services and credit provider, specialist property finance, focusing on sectional title, HOAs, and other property-related entities. Thanks, Karine. Sorry, yeah, perfect. First off is our normal vanilla loan finance products. This can include finance products for maintenance projects, restorations, refurbishments, solar, borehole, generator, lifts, municipal and creditor debt. We do include the projects for property owning entities such as medical equipment, finance and expansions. Our terms are fairly flexible. We usually offer 6 to 60 months repayment, but do offer longer terms for large capital projects where cash flow and affordability are essential. I think in this case, solar is a good example where the simple payback period is usually beyond 5 years. We thus assess each client's cash flow constraints to provide the best solution tailored for their needs. Our interest rates are usually set at prime +2, and the finance fee is IRR based, which is risk and term dependent. Just maybe some of the benefits for loan finance is the immediate capital injection to undertake urgent projects where the raising of a once-off special levy is not adequate given the time constraints at hand. This being usually the case where we've seen a lot now, where there's a council cutoff or structural defects where insurance cover can be revoked and urgent immediate works are required. The immediate restoration and enhancement of value entails to do a project now and pay it over term. This relates to specifically to the opportunity to market and resell units, example being repainting and refurbishment of a building. In some instances, we see now installing solar in common property as well. That will increase the property value today, allowing owners to achieve higher sale prices of units and uplift their related properties. I think the next point then is residual funds, which is a very important factor for body corporates, meaning that we've seen a lot now in the past that depleting all of their savings to attend to projects specifically happens. And when funds are depleted, the scheme is exposed should an unforeseen emergency occur where the scheme then does not have the sufficient cash buffer to cover these emergencies. Ultimately, a building which is in good structural and aesthetic condition provides for happier owners and improved lifestyle for the residents of the building. Specifically on our vanilla loans, there's no penalties for early settlement of any of our financial products. So if a loan is taken over 60 months and an owner wishes to settle in 6 months' time, we're more than happy to accommodate that, to which we'll send them a settlement amount and they can then settle their portion. Thanks, Karine. Next slide. Thanks. Okay, our next product is Levy Finance Solutions. LFS, as we call it, is a Levy finance product becoming more and more prominent given the economic conditions in South Africa. This relates to cash flow constraints within a body corporate due to non-paying owners in a scheme. The product is designed to alleviate pressure and advance the full levy arrears of a body corporate as a cash injection, and then to pay across the budgeted levies on the first day of each business month. Maybe just some benefits on why Levy Solutions is a good option for body corporates with non-paying owners. It's obviously the immediate settlement of all levy arrears. It guarantees both the amount and timing of levies paid to the body corporate on a monthly basis, which is extremely important if you think that there's a lot of owners in schemes which we've seen that pay late, and that in turn causes cash flow problems for the body corporate to pay their day-to-day expenses. It allows for the effective budgeting and financial management within a scheme. And obviously there's intensive credit control overseen directly by our in-house legal team and attorneys. The legal cost is serviced by Levy Solutions, which is a very important point, which is usually the cause for delay in collecting arrears, as it's the associated cost is usually paid by the body corporate. Levy Solution carries these costs to ensure the legal process continues and not depleting the scheme's cash. It provides protection against non-compliant owners, including strong legal support and oversight. And as I mentioned before, it eliminates cash flow crises, usually meaning that a scheme can't pay their day-to-day expenses. Again, as with the other financial products, there's no long-term contracts, and Levy Solutions can be terminated with 1 month notice. Thanks, Karine. Next slide. Okay. So this is the verification process we follow for body corporates and HOAs. The information listed below is just what our credit committee reviews before we do any loan quote, being the following. It's the latest 3 months management accounts, latest annual financial statements, and then obviously confirmation that the managing agent is a NAMA member. That's obviously applicable to non-Trafalgar clients, as Trafalgar is obviously registered with NAMA. And then again, very important, we always want to see the quote for the project and the equipment to be financed. Next slide. Thanks, Karine. Okay, perfect. These below points relate to verification and due diligence process we follow for company, trusts, and incorporates. So again, for company and corporates, we require the subsidy documents, specifically a core 14.3. In trust, specifically, we want to see the deed trust and endorsement certificate. Again, financial statements, 3 months management accounts, bank statements, and owner packs. The owner packs for Trafalgar, obviously clients, we can obtain, but for external clients, this relates to rent roll, surplus report, creditors roll, and all of the other mentioned ones, options as well. It's important for us to obviously see that if we finance a building, that there's not a high vacancy rate, and that obviously it's feasible for us to loan that entity money. And again, as per the previous ones, we want to see the quote for the project and equipment to be financed. Thanks, Karine. Next slide. So this is just some information and just a basic guide on how a loan is approved for a sectional title scheme. Usually trustees, directors would request a loan quote. TFS will request a qualified project manager to oversee the project. And I think this is a very important point. that quality work gets delivered with the correct guarantees and warranties in place. So that's a requirement we do have. After that, usually TFS issues a loan quote with a special levy schedule over the various repayment terms. Specifically, this includes the repayment for each owner per their PQ over the selected terms, giving owners the option to select the appropriate term that suits their needs. The loan quote, including the special levy schedule for the proposed work, is added to your agenda, usually for AGM, SGM. And then following that, both the project and the finance needs to be approved at AGM and SGM, and a special resolution needs to be obtained. The quorum needs to be reached and passed by 75% of the members present. This can also be done via round robin, with 75% of the members approving within reasonable time. And then after that, once TFS receives the signed minutes and special resolution, we can proceed to draw up a loan agreement. And once the agreement is signed and TFS receives the original copy, in today's day, we also use Adobe Sign, which makes it a lot easier. Once all of that is received, we can proceed to pay over the loan between 3 to 5 business days. Okay. And this is just the contact details, which will obviously be shared after the presentation as well. But this is obviously my contact details for vanilla loans. And then Adele Reineke, who's our attorney at Levy Solutions, who deals with specifically with our Levy finance product and the legal oversight on that.
So Christian, from a first inquiry, how long would it typically take to, get the quotes, do the special resolution, and then finalize the loan for payout?
So Andrew, on a company, usually we've seen with companies where they've already approved finance, that's quite quick. That can be anything between a week to 2 weeks. With body corporates, we've seen usually with the notice period for a normal type of agenda or a notice that needs to go out, it's 30 days. And then, it can range anywhere from 30 days to 3 months, depending on obviously the owner's feedback and with the trustees and deciding on an appropriate repayment term. But if something is approved or the resolution is obtained from a AGM or SGM, we can do a loan agreement within a week and pay the funds over in 2 weeks to conclude that.
Good. And Christian, just talk a little bit about the quotes. So, when there is an inquiry that comes through to you, what information do you ask and what will the quotes basically show the trustees?
Yeah, so I think first and foremost, specifically with maintenance related projects, if the loan quantum is in excess of 500,000 Rand, we'd like to see the qualified project manager who's involved with the project. We like to see tender processes to ensure that the work being done, and obviously the finance that we're going to provide is, in our minds, a safe investment for the body corporate to do as well. So, from that specifically external body corporates, once we receive the management accounts, annual financial statements, we can do a review within, I think, probably a day, 2 days, and revert back to the trustees. And in that sense, I think most of that information from a Trafalgar point of view from our clients are fairly easy obtainable from the PM directly. And most of the information we can obtain from that perspective immediately. So it's just for external body corporates that does take a bit more time because we need to do liaise with their respective PMs. And obviously obtaining all of that information does take longer if it's not a Trafalgar client.
Good. All right, many thanks. So Christian's details are there if there are any further questions that you'd like to refer to him. All right, perfect. Thank you. Good. Lady, we're moving on to you and onto the insurance topic. Thank you.
Perfect. Thank you very much. Good evening, everybody. So the points of discussions down the insurance, I'm going to go briefly over the grid failure exclusions that have been sent out by various insurers over the last couple of months. Replacement value surveys and the purpose, risk assessments by the insurers, material changes, hot water supply, and then just a quick overview on some claims. Corinne, you can change. Right, so over the last couple of months, various insurers sort of nationwide have sent out different types of exclusions when it comes to grid failure. And the reason for this has happened because most of our insurers need reinsurer backing. And as a result, with the reinsurers, there's a number of terms and conditions of cover that they sort of provide to our insurers, and those insurers have to adhere to that if they want the reinsurance support. So the notifications that went out was applied in terms of an amendment or an addendum to the policy wordings. And then I think, we need to also take cognizance of the fact that there's a difference between load shedding and electrical grid failure. With load shedding, we understand, as we understand it today, it's a controlled interruption of electrical power supply to the public. With it being a scheduled interruption, people can plan around the event. They can make sure that they take out, electrical appliances, from their walls, etc., to try and prevent damages. But when it comes to grid failure, we don't know when that's going to happen. You could go into load shedding, and from load shedding, it can just continue being off, and then it becomes a grid failure. But grid failure is also determined by way of municipalities. So it's usually not just sort of a single street or just a localized event. It's something that happens, for a whole sort of area. So you'll take the whole of Gauteng would go down with grid failure, or the whole of Cape Town, or the whole country for that matter. So they look at grid failure in that sense, where there's actually just a complete failure of electrical supply, versus load shedding, which is a scheduled event. It goes off for an hour, 2 hours, 3 hours, etc., and it comes back on. So the underlying issue here is that grid failure as itself is a non-insurable event. So the reinsurers have said they're not supporting it in terms of, claims that come out of it. And it's also largely due to the fact that over the last you could say the last 3 years, the number of claims that have come through for things like power surge damage, etc., has literally increased, across the board with insurers by about 200%. So the cost is large. It's not something that's sustainable. They can't continue covering things that we, and people don't really have any control over. It's a government issue, ESCOM issue. And so it does pose a problem for us as clients of any insurer. I know that on your personal policies, your contents and vehicle insurance, those insurers have also applied those restrictions. It speaks to, in the past, if your power went out for a couple of days and you had contents in your fridge, you were able to claim for those contents, provided you had a slip. The insurer would pay out, and you could replace your groceries and your frozen foods, etc. That's also no longer available, to us who have personal policies in place. You can no longer claim for your food. It's kind of become like it's one of those things. The insurers are not liable. So, so those are the two different events. One is controlled, it's scheduled, you can, plan around it. Grid failure, it's not scheduled, it happens suddenly, and people, we don't know necessarily for how long. It could be grid failure that goes off for 3 hours, and it could be something that lasts for days or weeks on end. So, and that's the reason why the insurers have come back, or the reinsurers are no longer providing that backup support to our insurers in South Africa. It's a problem. And I think the same has applied, when we went into the local shutdown during COVID. There was a lot of businesses on the commercial side that wanted to claim for business interruption because they obviously couldn't trade and they lost income, etc. And initially the insurers had rejected all of those claims, saying it wasn't anything, that it was not their fault, or there was nothing, it was a worldwide epidemic. It was taken to court, and it ended up that the insurers who had rejected those claims ended up having to pay billions out. And I think we're sitting in a situation now where we've got something going on in the country, and they're now preempting, sort of what could go wrong, and already excluding the cover so that, it doesn't impact the insurers as it did with the business interruption. You can go next to
Ladi, would you mind just commenting on surge insurance? So if there's a damage to an electrical component and installation which is specified, take CCTV cameras or an electric fence energizer, for example, is surge protection still covered?
Yeah, it's in the next slide. Oh, here we go.
I'm good. I'm
all
jumping.
right, so it's no problem. So the intention of grid failure exclusion was not to cancel out the power surge cover. That was not the intention. So power surge cover is still very much available. And it doesn't only happen because of load shedding or that. There's a lot of reasons why electrical equipment is damaged due to, power surge events. So it's not specifically excluded that the insurers are saying, well, now we're not covering it. If there's any power surge damage to your cameras, etc., we outright not going to cover it. If it's a load shedding event, and there is a slight jump, and it causes a surge to some of the electrical equipment, the insurers are still going to obviously look at the claim, they'll cover it, etc. So it's not completely excluded. They're not saying, well, sorry, we're just not paying any of those claims. So they are still looking at those claims. It's not a complete exclusion. They're just saying that in the event of a total blackout, it's a different story, because obviously your claims level and the cost of those claims are going to be very different to, a few clients coming and saying that, we've had damages due to power surge. Those are quick ones that you can fix and you can pay those claims, etc. But a national outage or a huge municipality outage does paint a different picture for the insurer. So it's not exclusively excluded. It is still noted on the policies. The cover is still there. Most of the insurers provide a power surge as a standard extension on their policies. Most of them are limited to 50,000 Rand. There is the option to buy up on the cover. So if clients wanted to have more power surge cover, we get quotes, and generally what happens is that the insurer then charges the difference in premium. So if you've got your first 50,000, which is free extension, and you want another 200, you're going to pay the premium on the 200, the top up cover basically that you want. So it's not a complete exclusion at all.
Lottie, maybe a good time just to talk about, particular fixtures or particular items which need to be specified, because obviously this cover only applies to components which are specified on the policy, which is a dependency for any claims thereon. So maybe just you could mention that, and who is responsible for identifying all of those items which need to then be specified to be covered with the policy.
Okay, so as I go on with the slides, I have also highlighted that. If you don't mind, then we can just proceed and then it'll come up in the later slide.
Okay.
Perfect. Right, so replacement value surveys, which Corinne did allude to in the beginning. The requirements in terms of the Act, that they need to be done every 3 years, needs to be done by a certified qualified valuer with an on-site inspection. So the reason for the replacement value survey is to determine that the buildings, the common property, and anything that forms part of the common property and belongs to a body corporate or an HOA for that matter is noted and specified on the policy. So basically, often what happens is that we have, we get insurance and we place the body corporate on, and then, sort of 6 months down the line, it happens that there's a claim for a camera that's worth 100,000, but no one ever told us as the broker that there is such a camera and that we need to actually insure it. And so these replacement value surveys are very important, because usually what happens is that the valuer doing the report gives you a complete breakdown of everything that is noted on the common property. So we can pick it up from there. There's an estimated replacement value for the items, and it goes for things, from your cameras, your guardhouses, gate motors, security equipment, anything of value that can be claimed for in the event of a sudden and unforeseen event that possibly should be specified on the policy. So when you have common property insured and you put everything under the building section of common property, what happens then is that when there's a claim, that section of the policy under the building, say if your cameras and all of that stuff is just noted under the buildings, it's only going to be covered for standard events. So storm damage, water damage, those kind of things. But if any of those items are damaged due to power surge, the insurer goes to the power surge limit on the policy, and that is what they pay out. So if your camera system, for argument's sake, is worth 200,000 and everything goes, but it hasn't been specified on the policy, ultimately what happens, the insurer is going to say, well, your limit is 50,000. The damages are due to power surge, and as such, we can only pay out that limit. Then you've got the other portion of it. It comes to the theft without forcible entry. So anything that doesn't have to be broken down to gain entry. So if you've got cameras on walls and they can easily be removed, they're not specified. There's no forcible entry. It's been stolen. The camera's worth 60,000. The theft limit's going to apply. In most instances, it ranges with the insurers between 15 to 30,000 maximum cover. It's an extension. There's no premium charged on it. It's also a cover that can be increased. So the reason for the replacement value survey is really just to determine that, number one, are your buildings adequately insured? Have we noted everything on the policy that should be there? If the survey comes back and trustees feel that, maybe the cameras have been overstated, etc., the trustees are welcome to get their own quotes and say, well, we feel that this would be a better replacement value. That's not a problem. The problem comes in if you're underinsured or you haven't specified items. Come to claim stage, you've got a situation where the insurer can then apply average on large claims, which means they pay out 30% of the claim. The trustees are then liable for the balance of the 70%, and then the repairs don't get done because the body corporate doesn't have the money. They didn't do what they were supposed to have done to make sure that there's adequate insurance in place, according to the latest building rates. So the valuers work in accordance with those rates to make sure that when you're rebuilding, that you're going to get like for like. So it doesn't help if you've got a 5-story mansion, but you're underinsured and all you're going to get back is a 2-bedroom house. So that's the reason why the replacement value surveys are important. It does help everybody to understand what the replacement value is in the event of a total loss, and then also to make sure that anything that should be specified on the policy is actually noted on the policy. So it goes for anything. It can be cameras, expensive gate motors. Some complexes are large. They have the larger gate motors that are maybe 30, 40,000 rands worth of a gate motor. They could have several of them. Those are all things that we need to know. We can't get to every scheme and do stock take of what you have. So, the trustees or the directors should say, well, these are all the things that the body corporate or the HOA has on their premises. Can you help us, sort through this? We're happy to assist you with that. We'll get a replacement value survey done. We can send somebody out. It's not a problem. But it's better to have enough insurance than to have too little insurance, because then everyone's left out of pocket.
Ladi, can you maybe just talk about practically what do you do when a valuation report comes to the broker? What should the broker look for? What are you going to cross-reference? What changes could be made? What will be the follow-through?
Okay, so I'm going to just explain it from the beginning. So let's say when we quote on a policy, so our initial steps of quoting on a policy would be, we'll get a letter of investigation signed by the trustees. We'll go to, that gives us the authority to only request the current information, policy information. So we can get the claims history. We need a full 3-year claims history. We need the current policy. So we use the current policy that you have in place. If it's with so underwriters or insurers or whatever, we take that policy, we'll quote on what is currently on the policy. We'll present the quotations, and we'll say that, when we take on new clients, we're happy to pay for that replacement value survey if it hasn't been done in the last 3 years. And the reason we do that is because we want to make sure that any building that we are the brokers for is correctly insured. So we will then, if the client moves across to us, we'll get the survey done. They send us a full report. The report is completely broken down into, the common property areas, what is on common property, the sections in terms of the plans, the value per section, the square meterage per section, and then if there's any, separate sections, like if there's garages that are sections on their own, those are noted separately with the sum insured, etc. We then take that survey and we compare it to what is on the existing policy schedule. So we'll work through the schedule, and we then provide constructive feedback to the trustees to say, right, this is your survey, here's the copy of it. This is what you currently have insured. This is what the suggested sums insured should be on your schedule. And these are the items that you should have noted on your policy. And at the same time, we'll present that with quotes, and then the trustees can then make an informed decision. We can also have a meeting around that. Most of the companies that we use to do the valuation for the surveys, they are also happy to talk the trustees through that, because obviously they are the experts on how they get to these numbers. So that we do it thoroughly, and that, you know, in 6 months' time, we wouldn't want the trustees to come back and say, oh, well, you didn't tell us. We did tell you, but the trustees ultimately need to make the decision and give us instruction in writing to say, please amend it, or please can we revisit, we feel X, Y, and Z, and then when we come to a mutual agreement, we can then amend the policy accordingly. So, you know, it does require engagement from the trustees or the directors. You know, sometimes you feel differently about values, you know, and those are things that we can discuss. But it gives us a platform to work off. And I think it's important, you know, just to understand it.
Thank you.
Okay. Doreen? Right, then I'm going to just talk to risk assessments done by the insurance company. So there's a difference between a replacement value survey, which really determines your values, what should be on your insurance policy, versus a risk assessment. So the insurance company that you're insured with will, at their discretion, from time to time, decide to do a risk assessment at your building. Sometimes it comes because there's been a lot of claims, and they'll send the risk assessor out to see what's happening at the building. Sometimes it's just a random pick to say, well, these are all buildings that we haven't surveyed in the past, and we now need to survey these buildings. So ultimately what happens is that the risk assessor we will be informed, we will advise the trustees that the insurer has called for a risk assessment. We'll make the arrangements. The risk assessor will then go to site. So what they do is, the purpose for the risk assessment is really to identify possible risks to the insurer that could lead to unnecessary claims and exposure for the insurer. So what they check is your fire compliance, general maintenance, any electrical wiring, housekeeping, general housekeeping, structures like stairs that pose a risk for slip and fall. You know, are there handrails on the stairs? You know, are they safe, etc. And any other compliance issues relating to the requirements of the National Building Regulations. So they will go out, they will have a look at the building, and they will then provide a report back to the insurer, and the insurer will then review the merits of the report. And if there's no requirements, we'll get no feedback. If there are requirements, then generally what happens, you can go to the next one, Corinne. Okay, then generally what happens is that we will then get a notice from the insurer, and the insurer will say, right, these are the items, this is the corrective action that needs to be taken by XYZ body corporate. We are giving you 31-day notice to advise your client that they need to attend to these. And then the responsibility then goes to the client to make sure that these items are attended to. Once they are completed, we will need invoices and photographs of the corrective action taken on those areas that we are of a concern. It's then sent through to the insurer. If the insurer is satisfied with the proof that they've received, any restrictions or possible restrictions are then removed. Or they could not be 100% happy and say, well, we're going to ask the risk assessor just to go back to validate. If everything is in order, corrective action is then done, and it's taken off the policy, and you carry on as normal. So where there are risks and the client has been notified and no corrective action is taken, the insurer then does reserve the right to cancel the policy to come off risk due to the exposure to the insurer, or to apply restrictive cover. So that the insurer can say, right, we're not prepared to insure you because we've highlighted the issues at your building. You're not prepared to actually take them seriously and understand the risk. And that risk is not only to the insurer, you're putting your owners at risk, you're putting visitors to the premises at risk, and it's creating unnecessary exposure to the insurer. So they have the right to say, well, we're not prepared to insure you. You know, if you fix your building and you want to come back, we can revisit. Or they can restrict cover, and they can say, well, we're definitely not paying for any claims that are perhaps, you know, water damage claims. We're not going to pay for those claims because you haven't actually fixed your roof. So we're not going to pay for any of those claims. If any unit wants to submit a claim, the body corporate is going to have to fix their unit. So restrictive cover in that sense, so they can just limit it completely. If there's an issue on public liability and those corrective measures haven't been taken, they can exclude public liability cover from your policy. You know, so there's a number of things that the insurer can do. The worst of all is the fact that, you know, you don't want to have restrictive cover, because obviously you then paying insurance, your premium is not going to change. You're going to pay the same premium, but you're going to have restrictive cover and you won't be able to claim. And the other problem is that once you get given notice from an insurer, it's very difficult to actually get insurance again, because then, you know, all of that insurance history, the insurer obtains that, whoever's going to be quoting for you, and it does then present a problem. So it's not a good thing either which way. We don't do it on purpose, guys, I promise.
So Bloody, I mean, just to close this topic, it's a very important one. So number one, it's initiated by the insurer, not the broker. No. So the insurance underwriter at their discretion, at a timing of their choice, when and if it's necessary from their perspective, will instruct a risk assessor from their side to go and inspect the building. And you've explained, you know, the reasons in terms of claims or in terms of, you know, an ad hoc sort of inspection. But, you know, I think this emphasizes the real importance of just keeping up with maintenance, regular maintenance, attending to things when they're broken or not working, especially waterproofing, those sort of things is important, because it will avoid this being an issue. And, you know, having seen this many times, it's not comfortable to get a risk assessment out of the blue with a long list of snags, giving you 31 days, which is not a very long time if there are extensive issues to resolve. And, you know, considering quotes and visits by contractors and getting work done, 31 days is not a long time to do it, and it's not timing of your choice. So it's definitely best to be proactive, to be preventative, to be consistent with maintenance, because if you work in that way in your scheme and there is good control of preventative maintenance on an ongoing basis, this is likely to be less important and less of an issue and a disruption than the reverse. So, you know, it's just good to know this does happen. You know, Bridie's mentioned the consequences. We have seen cover cancelled many times, and, you know, it does put the trustees at risk in terms of their responsibilities. It is a legal compliance issue to be insured, and it does place that insurance in jeopardy, and it's just something to avoid as best can be done. So just please, important takeaway from today's webinar. Thanks, Bloody.
Thank you. Next, Corinne. Right. Then material changes. I suppose this kind of ties back into your replacement value survey. But then there are other things that happen in the complex that don't necessarily have anything to do with the survey. So material changes is when something changes at a complex. That may impact your insurance cover. So, you know, the onus always lies with the trustees and or an owner of a section to inform the insurer of those changes. So, you know, this could be, you know, I've put a silly example there, but this does happen, you know, in complexes. So changes that where your scope of cover changes and it affects your risk, and it increases the insurer's risk. So for example, an owner setting up a home daycare operation from their unit, it's considered a material change. It's a risk to the insurer. You know, you've got to take into account, you know, you've got somebody that's looking after somebody else's children. If something happens to those children, where are they going to claim from? You know, we've had things like this happen in the past, and the claims come to us, you know, where children are injured at a daycare. And we were not even aware, the insurer wasn't even aware, and they try and claim against the public liability. You know, so things like that are very important. You know, a residential complex is a residential complex. If something is changing, if there's a business being run from a unit or a section or a clubhouse or whatever, you need to advise your insurer, because it definitely changes the scope of your insurance. It's not a case of, well, I'm only looking after 5 kids, but, you know, something can happen, and then who's going to pay? So those are the things, you know, servicing of your fire sprinkler systems for the larger buildings who have sprinkler systems, you know, those need to be serviced at regular intervals. When the servicing happens, they often need to be switched off for a day or 2, sometimes a week, depending on the size and what work needs to be done. You know, you need to advise the insurer that those sprinklers are going to be switched off, because obviously you're not going to have cover in the event of a fire. So it does pose a risk, but if the insurer is aware of it, then it doesn't impact a claim. If we don't advise them, they don't know, which means they can turn around and say, well, you never told us the sprinklers were off, so now we're not going to pay your claim. So those are just, you know, some examples of things that can change. and it can impact the building insurance, and it can lead to your claims being rejected. And then, in terms of owners who are doing improvements in their section, so, you might have bought your unit many years ago, and you've now decided it's time to upgrade it, and you've really put in nice finishes, wooden flooring, marble tiling, etc., but your value is X, and by doing those sort of changes to your unit and the upgrades, it's now going to change the value of your section. These type of changes or upgrades or improvements to any section need to be notified to the insurer so that we can amend your section and your PQ so that you are adequately insured in the event of something happening. So really, if there's a total loss and the insurer doesn't know that you put in 500,000 rands worth of improvements in your unit, they're only going to pay you out the R1,000,000. That 500,000 that you spent on your unit, you're not going to get it back because it was never noted on the policy. Again, the onus is on the unit owner to advise us, the broker, so that we can take it up with the insurer. The cost involved, so we can add it to the insurance. Yes, the owner is going to pay additional insurance, but unfortunately, if you want the cover, you need to pay for it. That's, that is the way it works, unfortunately, in this world of insurance. So yeah, and the same goes for the trustees or the HOAs, the directors of an HOA. If you've done improvements on common property, if you've upgraded security systems, if you've upgraded gate motors, anything that you've done that's a material change, where your values are going to change or it's going to impact the way the insurance views your premises, please advise us. It's an email, send the email to your broker. If it's not us, whoever your broker may be, tell them what's happening at your building, let them get advice from the insurance company. They will come back to you, they'll give you the correct information, and at least then everyone is prepared in the event of something happening. Unfortunately, we see it too often now with the change in the weather. It seems to be a worldwide thing. There's a lot of strange weather activity going on. Things happen. Last year we had, major storms in Durban that owners are still recovering from. And a lot of stuff there wasn't covered because those owners never said that things were on the policy. They never told the insurer. There was a lot of things on common property that they assumed would be covered, but they didn't specify it. So it's very important to make sure that everything that you need to have insured is insured. We understand that there are smaller things, it might be a little DVR or, something small that's going to cost 3,000 to replace. Is it worth insuring? Maybe not. If the building has sufficient funds, then why pay an insurance premium if you can just replace that because the cost is not that much. But you're looking at your bigger items, your 50, 60, 70,000 rand items, that if the body corporate is not flush with cash, and if something does happen, do you really want to lay out the cash as opposed to rather paying the premium and knowing that you have the cover?
So Blighty, just in practice then, you would like the invoice for that improvement should be sent through to the broker as a, as confirmation of what the additional value is that would potentially be covered on it. And presumably you provided quotes, what would the incremental premium be, which was then be charged to the levy account concerned if it's for the section and improvements in the section. And Blighty, would you mind just talking about solar, because it's a question that's come up. It's obviously very topical. There's lots of solar installations in various community schemes around the country. If not solar, generators could be an example as well. Just talk through the practicalities of those installations and what should happen in terms of the insurance policy.
Okay, so for the solar installation and the solar panels, where it's going on the roof of the body corporate, and it's going to become a fixture with an inverter and the battery pack, etc., and there's a crossover, a direct crossover, so it connects to the DB board. So if the power goes out, it automatically connects. We do recommend that it is put onto the building insurance policy. We'll need the cost of the installation for the panels, the batteries, the inverter, etc. Obviously, if it's going on a specific unit, and then we'll send it to the insurer, we'll get a quotation. We'll present the quote to the owner, and then the owner needs to make the decision if they, to go ahead with it. And the reason it's important that it's specified again, because if you have a solar system, have an inverter system, if it's damaged due to power surge, you are going to be paid according to the power surge limit. It's better to specify it. It's noted on the policy, and it's noted for its full replacement value. And then also, I know earlier a couple of months ago, we did a webinar on the solar installations and the panels. And in that webinar, it was said it's not common for the solar panels to be stolen Well, that's changed very quickly because now the solar panels are being stolen quite easily. So again, your theft without forcible entry is going to apply if your solar panels are stolen. So it is better to note it, insure it, and list it on the policy so that you have your full cover in place in the event of anything. For generators, again, if your generator is a plug and play, that you're going to plug it in when the power goes off and you're going to unplug it, that you can insure on your own personal policy. If the body corporate is insuring a large generator that's going to power up the common property and any of the units, etc., that should be added to the policy. We have a number of schemes that have added generators in their schemes, and those are specified on the policy.
Okay, thank you.
Right, and then just quickly, I just quickly wanted to chat about the hot water systems. So as brokers, we constantly deal with frustrated clients, and this is largely because sometimes clients have installed solar geysers or heat pumps, water heaters, gas geysers, and they haven't been specified on the policy. As a standard rule, most of the specialized sectional title policies provide automatic cover for your standard electrical geysers. If there's any other type of geyser installed, we need to be notified so that we can advise the insurer accordingly. Essentially what happens is that your standard electrical geysers are covered for, they have a limit of cover in place. It's dependent on the size of the geyser, so it's done on a sliding scale. And then what happens is that, I come and I've got a geyser claim and it's a solar geyser, and I put my claim through, and I'm very disappointed because I only got paid out 10,000 Rand after the excess when my entire installation cost me 25,000 Rand. And then the clients don't understand that you haven't notified the insurer, you haven't paid a premium to have that covered. So it is important that if it's not a standard electrical geyser, if it's a solar geyser, heat pumps, water heaters, gas geysers, boilers, anything like that's not a standard installation, and most people are going that way, obviously because of the situation in the country, please notify your broker so that they can get you a quote to make sure that you are covered. And that we don't have, owners are not left, paying for the shortfall on replacements of geysers. So, the current standard policy is there's cover for your standard electrical geyser installations. There's also cover for geyser maintenance. So if your thermostat or, the valve, etc., goes on the geyser, it can be claimed for. The cover is limited. There is an excess applicable, which is for the owner's account. But again, if any installation is more than what the limit of cover is, that shortfall amount will also be for the owner's account together with the excess portion. So it is important, just to know that, often, everyone assumes that the geysers are standard, and people don't sort of think to say, well, hang on, I don't have a standard geyser. I've actually got a solar geyser and I need to note it because it costs me a lot of money to install. So, just be aware of that. It is a cost implication to owners. If it's not put onto the policy. Next, Corinne. All right, and then just in terms of insurance claim and going back to geyser installations, all new geyser installations the invoice must be issued with a COC for the geyser installation. And this is to ensure that the geyser is compliant, and it's also to avoid that the manufacturer warranty is not voided. So in the past, a lot of the insurers insisted on the PIBR COC, which is obviously, the best one. However, there was a lot of sort of unhappiness about this because there is a cost implication for the PIBR certificate. And so the insurers eventually agreed that as long as they get a COC, it can be the local council COC, can be used, but a COC must be issued for your geyser replacement. And it's to make sure that your geyser is compliant, because if in 2 years' time your geyser bursts, we're going to phone the manufacturer and we're going to ask the manufacturer to replace that geyser. If the manufacturer goes out and that geyser is not compliant, they're going to void the warranty. The insurance is not going to cover another geyser replacement because the warranty period for all new geysers is a minimum of 5 years. And if that geyser bursts during the warranty period, they're definitely not going to pay for it, which means that the owner is going to be liable for the replacement of that geyser. So please just be aware of that. Sometimes there is additional work that needs to get done on the geyser to make sure that it is fully compliant. And unfortunately, the geyser limits are the geyser limits, and that is only what the insurer is going to pay. Anything over and above that is going to be for the owner's account. And then also, we've had a lot of requests when we've seen units being sold where the transferring attorneys are also asking for copies of those COCs. So that also seems to be something that's kind of out there. And then just a general thing on claims where there's internal water damage to a unit following a roof leak. So our insurers cover those internal damages for a unit owner. Okay. The problem is that we often sit with very frustrated owners because in order for the insurer to approve the claim, they need the proof of leak repairs. So that applies, I'm going to say it's going to, because on the next slide, it talks about leaking pipes as well. So if there's a roof leak, it needs to be repaired. We cannot wait for 6 months for trustees to approve a roof leak. It can't wait because, for the general maintenance that's going to be run for your routine roof maintenance that gets done annually or biannually, whichever. If there's a roof leak, the roof leak needs to be repaired. We need the invoice. We need proof that it's been done in order for the insurer to say, right, we're happy to authorize the claim for the damages and get the unit fixed. If there's a constant reoccurrence of roof leaks and they are happening in the same place and the same units keep claiming for damages due to roof leaks, the insurers are eventually going to start rejecting those claims. So your roof maintenance, as Andrew mentioned earlier, roof maintenance is of utmost importance. Cleaning gutters, etc., preventing leaks. Where there is an issue with the roof, move, tiles move, etc., please, put them back. To avoid unnecessary claims, because roof leaks are really unnecessary claims, and some of the damages that we get are quite severe inside a unit and can end up costing not just 5,000 or 10,000 rand. Some of them can run into the 80,000, 100,000 rands worth of claims. So I appeal to the trustees when there is a claim for a roof leak and you are advised, if we can, if those can be authorized and we can get the proof of repairs in order to proceed with that claim for the owner, it really goes a long way. We sit with a lot of claims that are open for months on end because we can't do anything with it because we just don't have the proof of repairs. On the next slide, Corinne.
So, Bloody, let's just say the reason that's like that is it obviously doesn't make sense to repair the resultant damage until the cause of the resultant damage is fixed. Because if the roof isn't repaired, then the damages could happen again and the repairs could be damaged, and so it would go on. So it makes sense that the underlying cause is definitively resolved, and that's what Blaady's saying. And we've seen many cases, many times actually, where the delays also rise because they can be big projects. Very often it's not only one area, it's a big area and it's a big project and it costs a lot of money, and therefore there's 3 quotes required. It takes time to plan. It might only be able to be done in a dry period of weather, etc., etc. Sometimes the building doesn't have enough money to address the underlying cause, all of which can cause serious delays to get the job done. So yes, the owners get frustrated, they see ongoing delays, but it's important to understand why the delays are there, how they're being addressed, and if necessary, the CSOS Ombud is always there for an owner to approach the Ombud for an external review and a binding ruling, because sometimes the trustees need encouragement to deal with something on an urgent basis, to have an instruction to get it done and to move forward decisively, because individual units could be compromised. Blighty, you might want to comment. The other thing we see often is where there's leaks from a section above to a section below, there often is no common property between those. And, once again, the downstairs resultant damage can only be fixed once the cause of a leak upstairs has been fixed. And that requires the cooperation of the owner there to allow access for contractors, maybe leak detectors, etc., and to trace it. And unfortunately, sometimes, the upstairs units are not particularly cooperative. The other thing we see, are you going to talk about pipes too now, Blighty, where these cause the very same leaks?
Yeah, so I was going to talk about the leaking pipes, on common property or between units. So again, the leaking pipes are not anyone's fault, but they're not covered in terms of the insurance policies. The insurers regard it as a lack of maintenance. It is a bugbear, sorry, Because in most instances, you know, we don't do maintenance on our pipes that are hidden in our walls. So you're not going to know that there's a leak on it, you know, until such time you see water coming from somewhere, and then you're going to investigate. So I think it, you know, so it is a problem. I know it does frustrate owners that insurers don't cover the leaks, but they do regard it as maintenance. They cannot cover everything, you know, in terms of you know, pipes, etc. So, you know, where there's leaks between units, I mean, we really battle with those claims. We also battle in terms of the excesses, because the unit owner downstairs who's now suffered the damages feels that he shouldn't be paying the excess because it wasn't his fault. You know, not understanding that it, you know, it's an event that occurred. It wasn't a deliberate action taken. It wasn't malicious. It's just something that happened. But unfortunately, in terms of the act, I know each owner that registers a claim for damages is liable for the excess. And it will only be by mutual agreement between the two owners that the unit above who had the leak maybe agrees to pay the excess on behalf of the owner downstairs. So those are, you know, those are issues when it comes to claims. Burst pipes, you know, at this point, you know, when there's a leak in a pipe, we, you know, and the client says, well, they think it's burst. We always say you need to do leak detection, and they need to identify where the leak is coming from. If once you open up, or the plumber opens up the area and they establish that it's actually a burst pipe, provide us with a full report as to what caused the pipe to burst. Send it to us with the invoice, and we will always submit that to the insurer, because from time to time they will cover the burst pipe. If it's a sudden unforeseen event, you know, provided the pipe's not rusted and it's not deteriorated, etc., the insurer, you know, that they will sometimes consider covering the burst pipes. And in the event that they cover the burst pipe, they will also then cover the area that maybe needed to be opened and closed again, you know, made good, where the pipe was located. When it comes to leaking pipes, a leaking pipe is a leaking pipe. They're not covering the pipe. They're not covering the opening of the area. They're not covering the repairs to the area. All of that, unfortunately, does fall to the owner. That has to then attend to those repairs as well once the leak has been attended to. So pipes do deteriorate, you know, the quality of the water might have an impact. You know, there's a lot of reasons for it, you know, all which are not within, you know, it's not an insurable event. It is something that happens over a period of time, and hence the reason why the insurers do not cover it. But I do want to say that in terms of pipes and leaking pipes and leak detection, there are some insurers will provide a small amount of cover for an owner to get the leak detection done. Some will pay up to about 1,500 Rand. You know, if the cost for the leak detection is a little bit more, then, you know, they will advise the owner they have to pay them the difference. But ask your broker the question, ask them to check with their insurer. You know, do they provide any type of cover for the leak detection? Because it also helps if you know that there is a little bit of cover and a little bit of reprieve in order to at least identify where the problem comes from. So, you know, check that with your broker. They should be able to advise you, you know, if the insurer that you're insured through provides, you know, that sort of little bit of an extension of cover for you to actually identify where the leak is.
All right, well, we've come to the end of our time, so it's just after 6 o'clock. So thank you very much for everyone for joining us. I hope you found that informative and useful. Here are all our contact details. If you've got any questions, you're more than welcome to inquire with us. We'll gladly get back to you right away. Those that have asked for the slides and webinar recording and Q&A, we will get that out to you. Thank you very much indeed. And we will send out an invitation for our next webinar, which is on the 27th of July, Thursday at 5 o'clock. The topic we're going to cover next time is going to be governance best practices, which I think is a really important topic, an interesting one. It really is the responsibility of trustees and directors to achieve that, to understand it, and to work in that manner. And we're going to go through all the important governance items and milestones and recommendations on how to work towards those. And hopefully that'll be an informative and a useful session in July. So thank you, everyone. I hope you have a good evening, and we'll convene next time in July. Good night.
Bye now.